My name's Siew-Kee Chen. I'm a Deloitte tax partner in the Sydney office, specialising in the funds management industry.
And my name's Patrick Broughan. I'm a tax partner in the Melbourne office of Deloitte and specialising in the financial services industry. And Siew-Kee, I'd just like to ask you a question to start off with, and it relates to, there were some announcements in the federal budget handed down a few weeks ago that relate to the funds management industry and how that will affect the direction of the funds management industry going forward. I was just going to ask you what your thoughts on those changes were.
Sure, I'll answer it in a very broad sense and then look at some of the specific details. In a very broad sense, the proposals can be summarised. They're really looking at protecting the integrity of the tax base rather than primarily encouraging further investment offshore and onshore in the funds management industry. So the proposed changes related to stapled structures. They also related to managed investment trusts, CGT discount. And really both of them are driven off concerns from the government to address perceived integrity issues. And so we will see over the course of the next few months and the few years that directional change in terms of the government announcing further changes to protect the integrity of that. And when we step back from that, there's a few things that it relates to. One is that when we're looking at the future of the Australian funds management industry, really what the key focus is really how can Australia attract foreign investment into Australia. This to some extent provides more of a disincentive in terms of foreign investment. Yes, it provides integrity, but there is a question around that. And so the second part is we'll talk further on during the course of today in terms of what are some of the things that we're seeing offshore and what can we learn from that and what does that mean for the industry. So they're primarily the things that my observations from the budget. Patrick, still talking about the budget from a few weeks ago, the government did talk about franking credit proposals and refunds in particular. And we've seen a difference with the opposition, Labor Party, in terms of what their thinking is. Can you explain what the differences are and what does that mean?
Yeah, sure. It's really interesting in terms of that sort of broader policy argument. And if you look at, if you take a taxpayer who's in a tax-paying situation, franking credits are valuable in the sense that they can offset the tax that they might otherwise pay. The real difference between the government policy at the moment and the Labor Party policy in relation to franking credits comes down to essentially the use of franking credits when through self-managed super funds or industry funds for that matter, where the ultimate taxpayer is in retirement mode and the super fund is in pension mode. And the significant difference is the current government, and that has been policy for a number of years, would refund the franking credits where the self-managed super fund or superannuation fund has received franked dividends. The Labor Party, their proposals essentially seeks to no longer refund franking credits. And just to give you a perspective on it, if you think about three taxpayers, let's assume there's three taxpayers and they're all different taxpayers. They all run a self-managed super fund and the taxpayers are in retirement mode. So the income of the super fund's exempt. So the first super fund, let's say it goes out and invests $100,000 and it might invest it in a term deposit. And for that, it might receive let's say a 3% return. The self-managed super fund receives that, it's in tax-exempt mode, so the super fund retains the full 3% and is able to pass that on through the pension to the superannuant. Another taxpayer, second taxpayer, same situation, but they invest in let's say a rental property. And again, I know it's hard to buy a rental property for $100,000, but
especially in Sydney.
Yeah, well, they might be looking in the country. They get a 3% yield on that. And again, it's the same situation. Term deposit, fully exempt. Rental income, fully exempt. So those two asset classes, no tax in that situation. The third situation is if you assume that the third taxpayer, instead of investing directly into a term deposit or into a rental property, buys shares in a company. Well, let's assume the company does exactly that, invest in a term deposit and a rental property. The company will, and it gets a 3% return, say, just to keep the numbers simple. The company will pay tax, and let's assume the company distributes that after-tax profit to the self-managed super fund. The company will dividend essentially a 2.1% return, because 30% tax on 3% is 0.9%. The company gets pays a dividend, and the self-managed super fund receives 2.1%. Under the existing policy, to make the term deposit, the rental property, and the shares through the investment through shares equivalent, the super fund will receive a refund of the franking credits that was on the dividend that was paid, that represents the ultimate investment in term deposits and rental. Under the Labor policy, that super fund won't be entitled to the exemption, or it won't be entitled to the refund of franking credits. Does that make sense? Well, what it will do is it will encourage people in those taxpayers, the third taxpayer in that example, to invest directly into those type of direct assets, rather than through listed or non-listed company arrangements. And there doesn't seem to be any compelling policy reason why that should be the case.
So it will skew the investment preferences to direct rather than going to collective investment vehicles.
Exactly. And it's the same issue through a trust. If the trust then invests through shares, you've got that similar problem of the non-refundability of franking credits. But that's probably enough about Australian tax reform, which I must admit there hasn't been a lot of in the last couple of years. But where we have seen a fair bit of activity is in the US and the very significant tax reform that the Trump administration has started to implement. How do you think that'll impact the funds management industry in Australia?
It's a good question. We look at what Trump has done. He's done a number of things, obviously, and said a number of things as part of his platform. And one of the centerpiece of what he's done is the US tax reforms, and in particular, cutting US taxes. And it's been said that it has been, since the Reagan administration, no other tax reform has been this immense since then. And he's done it in a tremendously quick amount of time. So he's been able to rush that through in a matter of weeks, when even the Reagan administration took 1 or 2 years to pass that through. So that's the first observation, that the corporate tax cuts that have been implemented by the administration at the moment in the US have been far-reaching. That has an implication in terms of the way in which the world is reacting, and then it has an impact in terms of what we think and what I think the funds management industry in Australia will respond as well. Looking globally, prior to these changes, it was darn difficult to invest in the US, as you know. So that is, you really need to be motivated because of the high tax rate.
Not to mention all the administration that
correct.
So you invariably put through.
Yeah, so you've got really high federal tax rates in the US. Then on top of that, you've got state taxes and other taxes as well.
City taxes.
That's right. And so the effective tax rate effectively became well over 40%. And so the long and the short of it is you really need to be motivated to invest in the US. But with the corporate tax rate cut, it has put the US in a very competitive playing field. And it really creates a big difference now between where Australia stands and where the US sits. And we talked earlier in the course of this discussion as to where the budget was recently heading. And the budget was recently heading in terms of protecting our revenue base. whereas the US platform is taking a fundamentally different approach. And that approach is that we will give up tax revenue with a hope that from an economic point of view will attract investment, will bring profits and income onshore and capital to invest locally, and that will then in turn drive revenue and therefore taxes. So it's very counterintuitive. Mm. And when we look at that on a world platform, that has implications. It has implications because if one of the world's largest economies dares to do that, the rest of the world will surely follow to some degree. So that's one aspect which is really relevant from a global standpoint, which is relevant to our discussions in terms of where we're heading on a corporate tax cuts. But it becomes relevant when we also look at what we will do in the context of our funds management industry. And that is when we're looking at what kind of tax reforms we will make, how we will make our landscape, and in particular our withholding tax, competitive. Really, we look at the US in terms of that idea that rather than protecting the integrity of the existing revenue base from a tax point of view, we look at the flip side, which is if we do give up tax revenue, what else will we gain from that? And we'll talk more a bit about that in the course of this discussion, but I certainly think that there's going to be a lot of thought that will come through. There's a significant impact beyond just the US when we look at what is the impact of the Trump economics, Trumponomics in the Australian landscape.
Is this a race to the bottom in terms of tax rates?
No, I think if we look at the US, they were much higher than the rest of the world. So well over 40% in terms of the effective tax rate. And now they're levelling out, so they're mid-range. But Australia is well above par in terms of median. So really it's more about how can we get it calibrated so it's closer to a competitive landscape within the OECD. But you're right, quite clearly you can't go to a 0% rate, but from a competitive landscape, you do want to make it so it's competitive with at least the OECD countries. And where it is at the moment is Australia is well above par, certainly when looking at where the US is heading.
Right.
So Patrick, talking about the tax cuts in the US, again, if we turn back here to Australia, what's your view of the proposed tax cuts that's been announced in the most recent budget by the current government?
Yeah, well, I think everybody probably knows about how the corporate tax rates are just stuck. They'll be what they'll be ultimately, and they're a significant way out in terms of ultimately cutting tax rate to 25% for large corporates, and there's probably 2 changes of government before we even get to that time frame. So if we put that on ice for a minute, and we just look at the personal income tax, there was a really interesting article by Chris Richardson from Deloitte Access Economics. I think it was yesterday or the day before, where he focused on the fairness of the tax cuts that have been announced by both the government and, in reply, the opposition. And the sort of classic quote from Chris was that he was going to throw a brick through his television, but he's too cheap. So his perspective was, and I thought it was a pretty interesting perspective, was that at the moment, at one end of the scale, you have the top 10% of individual taxpayers, individuals I'm talking about, pay about 50% or a bit more than 50% of the total tax take for the payment of personal income taxes. And you've got to remember the personal income tax is a major part of our budget. It's more significant than the GST part of the budget. So it's not just a small portion on the side. It's a significant part of the budget. And at one end of the scale, you have 10% of the top 10% taxpayers, personal taxpayers, pay over 50% of personal income tax. And at the other end of the scale, you have about half adult individual Australians pay no net personal income tax. So that's you look at the tax cuts from that paradigm in the sense of at the moment you have 10% paying 50% and half the population, adult population, paying no net personal tax. And you can debate that black and blue about whether that's fair or not, but that's why it is. Just going back to your comparisons, the comparisons with other OECD and wealthy countries is that the Australian top tax rate is high compared to the other OECD countries and comes in at a much earlier rate than most other OECD countries. So we paid the top marginal tax rate, which is high comparatively, much sooner than most of the other OECD countries. So that's the sort of prism that Chris is looking at this from. And his analysis, if I can quote him correctly, is that the government's tax cuts policy, all it does is just return bracket creep. Gives you back inflation that they've taken over the last number of years. The fairness or unfairness, depending upon your perspective, of the Labor Party is that what they're seeking to do is extract about another $16 billion per annum from that top 20%. So increase that top personal income tax, effectively increase the rate just through inflation, and that will return the budget about another $16 billion. Fairness, we also have to look at competitiveness. Australia relies on personal income tax significantly. It comes in at a very fast rate in terms of the income which gets taxed at the top rate. It comes in quickly, and it's a very high rate comparative to the OECD. So does it make sense? Is it fair? You can make your own judgment. But they're the sort of parameters of where those the prism to look through what those tax cuts look like. But probably enough about tax cuts and Trumponomics. What about, I think it was on the 30th of June 2016, the Australian government signed a memorandum of understanding which effectively introduced the Asian Funds Passport. The Asian Funds Passport being a passport to issue fund management products more generally than through Australia, more the Asian region. Can you tell us how that might pan out over the next couple of years, whether that's a sort of significant change in where we've come from, and will it have a significant change on our competitors, or is it something that sounds very impressive but less ferocious?
It's probably all elements of both, but in broad terms, there's huge potential for both the Australian funds management and also the Asia Pacific region. But in short, I think it'll take a long time rather than in the next 1 to 2 years.
And who are the parties to it?
So there's a number of countries, Australia, New Zealand, South Korea, New Zealand and Japan are the main participants. There are other countries as well that are participants, though haven't officially signed up as yet. Is
Singapore going to join?
Yeah, Singapore is one of the participants that are there. They haven't officially signed at this stage, and their support will become important and relevant as time progresses. And when we look at the Asia Pacific region, there are other regimes. So there is the ASEAN regime. There's also the Hong Kong and China regime. So there's a number of different passport regimes in various forms. And perhaps the most famous is really not in the Asian region. It is in the European space. And in the European space, when we look at the way in which they've done their passport regime, so the UCITS, the CCAVs, they've done that for a number of years, 15 to 20 years. And we're up to about the third version in the UCITS, and it's become very, very successful. But for that to become very, very successful in terms of that idea of a passport, a regulatory system that can be freely traded throughout the European Union, they've taken about 10 to 15 years to get that up and running, and it's in the third iteration. And so I couch my comments as to why I see this as being a tremendous long-term impact over exactly that. That is the long term.
And what will be the impact in terms of what will be different?
Sure. At the moment, if when we look at the Australian funds industry, if we were to try to export that into the neighbours, the Asia Pacific region, there's regulatory hurdles that need to be surpassed for each jurisdiction. And these regulatory hurdles are by no means easy. And so they'll need to do that. Each fund manager will need to go into each home jurisdiction in Asia Pacific to satisfy their own regulatory requirements. So it won't be as easy as just setting up locally and then being able to distribute throughout the Asia Pacific region. They'll also need to satisfy each of the local tax requirements, amongst other things. And so there's high barriers. But imagine if we had a free trade. That is a free trade arrangement where countries that signed up would essentially be able to distribute their products and their expertise to capture investments and investors throughout the Asia Pacific region. That really is the heart of the Asian Region Funds Passport idea, that the countries which are signed up will have a free trade in the funds management regime. And the opportunities are large, because when we're looking at this region, Australia has the largest funds management under so the largest FUM that it has is in Australia. And when looking at that, the export of that is only very marginal. It's only very small. And so the opportunity for Australia is how can it use its existing base, its expertise, and be able to export that overseas. At the moment, it's the Europeans, through their UCITS, their CCAVs, they capture about 40% of the market in Asia Pacific. And looking at the future, particularly with a growing middle class, other countries in Asia Pacific that don't actually have the same superannuation system that Australia has, there's really a need for a longer term retirement superannuation type product. So there will be a demand increasingly for an Australian style funds management expertise. The Asian Region Funds Passport will provide that. But when looking at Australia, we've had a number of stepping stones to achieve that. The first part is that no one really understands our trusts. It's an archaic system.
The British do.
And perhaps some other common law countries.
Yeah, but the civil law countries have no idea.
Exactly. And even common law countries do struggle with our concept of what a trust is. So that's the first part. And through the years, Australia has reformed that so that we are using, and the proposal currently is to use a corporate structure. And that corporate structure is much, much more familiar to overseas investors than our trust structure. But having said that, it will be a corporate style structure that has all the features of a trust taxation style product.
Flow through
taxation. Oh. So at the moment we don't have that. We don't have a corporate vehicle with flow through trust taxation. The proposals at the moment in terms of the corporate collective investment vehicle are exactly that. It's designed to allow Australia to have a vehicle that will be attractive to foreign investors. And that's a stepping stone. It's a stepping stone to allow Australia then to transition and fix up its domestic law to get into the Asian Funds Passport. Then the next phase, when we look at that, is Australia, together with other countries, have signed up to the Asian Funds Passport. But we need to get the local domestic law. And Australia is well ahead of the curve. Other countries are as well. Once we get the local laws up and running, that's not the end of the story. The next phase then, in terms of the Asia Region Funds Passport, is which country in Asia Pacific will be, in one sense, like the Luxembourg or Ireland of Europe. So which country is
going to capture the market?
Correct. And that really does bring in one aspect, which is one huge barrier which the Johnson report and the second Johnson report had articulated and reiterated, is that our withholding taxes are too high. They're not competitive. And it comes back to the discussion that we've had, and that is when looking at, from a policy point of view, do we aim to protect our revenue? That is, with our withholding taxes, there's any number of rules, and really we want to have integrity. And even in the Asian Funds Passport, that we need to ensure that we're ring-fenced, that no one takes advantage of any loopholes. Or do we look at offshore and that is the counter idea, as is expressed at the moment in the US from Trump, and that is in order to actually attract investment which would otherwise not flow to Australia.
Do you loosen it up?
You need to give up some revenue. And there's data that actually shows that Australia doesn't collect that much withholding tax revenue anyway, relatively speaking. And so
No, it's personal income tax.
So when looking at the withholding revenue base, there's one piece around that. But leaving that data aside for the moment, the key aspect is that if we make Australia's withholding tax much more competitive than it currently is, there's an opportunity then. There's an opportunity to be, when we look at the European experience, for Australia to really be the centre of the Asian Region Funds Passport. And so that's the different phases of what I see the Asian Region Funds Passport playing out. You can see there that it's a long-term play. It won't be immediate. There's a number of things that do need to happen. And whilst I'm really hopeful, and I think that in our lifetime we'll see that there'll be a tremendous positive outcome arising from these changes, it's a long play. It's a long game, and we look to the European experience as a great example of how long it will actually take. But once it works effectively, we'll also see that it's a very critical part of the development of the Australian funds management industry, locally here as well as offshore. So Patrick, we've spoken quite a fair bit about tax. We've spoken about the budget, but maybe if I turn a bit more closer to home to you, Patrick, you've had a long career at in a Big Four accounting firm as a partner and otherwise. Can you tell us a little bit more about what you've seen, and also share some thoughts as to what that means to be a partner, as well as what it means for future generations as well?
Sure, and you're right, Siew-Kee. I've been in the tax profession for about 40 years, nearly 40 years, not quite.
That's longer than some of our graduates been on Earth.
Yeah, most of them. So tax reform and tax change, it's in some sense a bit like growing old, dare I say it. You just absorb them as you go through, and it's really when you look back is when you see how profound some of the changes are. And when I'm just reflecting now on the sorts of things that have been really profound in the tax profession over the last number of years, is the introduction of CGT in 1985. Major change. Introduction of, and we don't get tax reform very often, so 1985. There was another bout of tax reform in 2000 where GST was introduced, and I think in 2001 the debt equity rules were introduced. In 2002 the tax consolidation rules were introduced. So 2000, 2001, 2002, tremendous amount of activity and focus around tax reform on those matters of introduction of a GST, of tax consolidation, of a better definition of debt and equity. Then there was a bit of a gap, and it was about 2007, I think the MIT rules for the funds management industry were introduced. And there's been iterations of that since with the AMIT rules, but we haven't seen genuine tax reform for a long time. And my sense of why that is that I think governments need there's going to be winners and losers, always winners and losers on tax reform. And the government needs a substantive majority because they know it's going to be winners and losers. So they've got to be prepared to lose something to gain something. And for the last umpteen years, there's been no large majorities. So we just haven't seen the tax reform. So that's one thing. But just going back to your point about vacationers, they say trying to enter into Deloitte or any of the other big firms is about as hard as it is to get into Harvard University. We have more graduates applying, or more applications applying, and we probably knock back more people Harvard knocks back. So the threshold to get into the Big Four now is really high compared to when I started. That was quite a different story back when I started. What I would say to any person who's now thinking about a career in the Big Four, and particularly in tax, one thing doesn't change, and it's probably what they tell their graduates or what their parents would tell their children: do really well at university. You don't even get an interview if you don't have really exceptional marks. So focus and do really well at university. And I interview a lot of vacationers and graduates, and they genuinely are pretty outstanding. But that gets you an interview. So then there's another process, and ultimately when it comes to interviews with partners like myself, there's a couple of things I look for, and I've got kids, and I tell my kids exactly the same thing. I'm sitting there interviewing a graduate, and my ultimate question is this person a good cultural fit for our team? And the graduate's sitting there assessing me about, do I want to work for this team? So it is a two-way bargain at that stage, because you get the best and the brightest, and they've got other alternatives. So in their sense, we've got to appeal to them, and they've got to appeal to us. And the sort of things I look for in my discussions with graduates is, are they a good cultural fit? How do they support their community? Are they engaged in community type activities? Can they work in a team? That's really important, because just about everything we do in the tax profession and generally in the Big Four, it's all team-based. So it's really important that people work in a team. And the final thing that I'm pretty keen to understand is, how do they deal with difficult situations, in the sense of, you've made mistakes. How have you approached it? What have you done? What have you learned from it? And you get that you get some feedback from the vacationers and graduates about the sorts of things they've been doing and how they handle, mistakes, errors, that sort of thing. And it's really important that when I'm assessing that people take responsibility. Yeah, everyone makes mistakes. People take responsibility for it. It's not somebody else's fault. You've got to own the problem. But anyway, Siew-Kee, I'm sure you also interview a lot of graduates, and do you have any final comments that you would add to that?
Yeah, similar vein. I'd probably divide it in another way, with the soft skills versus the hard skills,
technical
as it were.
skills.
And I think certainly in the early years, the hard technical skills, the ability to write well, to follow instructions, to know the tax rules, they're really important. The soft skills are very important, as you've mentioned. So both the leadership, the ability to communicate, the ability to have empathy for others, they're really important as well during the junior years. But certainly as one progresses through, some of those hard technical skills almost become a given.
Yes.
So your ability to write, your ability to know the law and how to understand it and solve, they become a given.
Yeah. And what's the law actually trying to do?
Yeah.
It's also a significant battle in trying to understand.
And to your points then, I think certainly at the later stages of the career, as you progress to become a manager and certainly director and ultimately a partner, the soft skills become really, really critical. And to some degree, it really is the distinguishing feature in my mind. There are a number of technicians that are just in the industry because they're just highly intelligent. But by and large, I think it's the soft skills that really differentiate, because it's at that point, Can you influence the industry? Can you really lead? Can you influence the direction? There's soft skills and leadership skills, which to some degree you can demonstrate when you're at university, when you're at school, whether you're leading a team, a sport, a society, or the other, and you'll be able to extract that. So coming back to that interview phase, it then certainly becomes important when I look at it, that it's both a combination of both the soft and the technical skills. That is, the person that we hire, can that person, as you say, fit within the team? Will they do well? But ultimately, will that person, can we take this person all the way? Do they have that skill set? You can't obviously answer that question straight away, but if they've got what we look at in terms of the very beginnings of both the soft skills and technical skills, I think that takes us a long way. So it's a really balanced approach in my mind.
Siew-Kee, all I can say is I'm glad you didn't interview me when I was a graduate. Thank you very much.
Thank you, Patrick.